welcome to the latest edition of Skipton Talks, an educational webinar series put on by Skipton Building Society to help you and your clients find a way when it comes to mortgages. I'm your host, Jonathan Evans, Senior National Account Lead here at Skipton Building Society, and this morning I'm joined on the sofa by Jen Lloyd, our Head of Mortgage Products and Propositions, and Ed Cowan, Senior Capital Markets Lead here at Skipton Building Society. So just to sort of frame it and give an overarching view before we dive into some of the questions here, we are operating in a volatile environment. The first 2 months of the year, January, February, the market got out the blocks pretty quickly. It was quite a strong start to the year in the mortgage market. Then March came along, the Iran conflict kicked off, and it's still ongoing at the moment. Energy prices, oil prices skyrocketed and spiked. Then Moneyfacts printed that average interest rates for fixed rate were about 4% in April, and they then became 5% in May. So an increase of roughly, on average, about 100 basis points in the space of a month. No surprise at the same time, mortgage approvals then went from about 66,000 in April to 56,000 in May, so a drop of about 10,000. And then more recently, we've had Keir Starmer resign, and also Andy Burnham come into control at number 10. So very volatile, there's a lot happening. So let's try and help some of the listeners and some of the people tuned in to unpack some of that, to help them sort of have better conversations with the clients, okay? So we'll start off with you, Ed, and please feel free to pitch in as well, Jen. So one of the biggest questions that we get asked when we're out speaking to brokers, speaking at events, on panels, etc., it's about base rate. So where do we expect base rate to be over the next 12 to 24 months? And does that differ from the market view?
So I guess if I start with where the market is at the moment, so the market this morning was pricing in 2 hikes for the Bank of England, first to come in around December time, and then the second to come in sort of June next year time, so getting us up to 4.25%. In terms of our Skipton view, we do differ from the market. Our view is that unlike what we saw in Ukraine maybe 4 years or so ago, we think that the impact on inflation will be much less this time round, so we can maybe go into that on a bit more detail later on in the webinar. But because of that, it means that the Bank of England potentially don't have to hike as hard. Our view is actually that they hold at 375 into next year to see through inflation dropping back out from the impact from Iran war, which will enable them then to actually begin cutting again, because our view is that the economy is stagnating at best. We've got minimal growth, whilst the Bank of England's mandate is inflation driven. They do want to look at the economy as a whole, so being forced to hike only stifles that growth even further. So their preferred path would be to be cutting. So we think that they look through that and hold at 375 for the rest of this year.
Excellent. So our view is definitely slightly more optimistic than what some of the other market commentators are forecasting. So the cool kid in the block's base rate. Everybody talks about base rate, bank rate, but what's our outlook for swap rates and mortgage rates rather than just base rate, and why is that important?
So it is very important, and I think the key thing for those that are listening today to make sure you're clear on is that when base rate moves, it doesn't necessarily mean that swap rates are going to move and therefore mortgage rates are going to move. Swap rates are derived by the expectation of where base rate and SONIA, and if those are not clear on what SONIA is, it's very close to base rate, so you can think of it from a base rate point of view. So your swap rate is trying to predict effectively where base rate will move over a period of time. So as long as markets currently are expecting base rate to rise, then your swap rates are elevated. And as you said, they were over 100 basis points higher at one point. They're still 70, 80 basis points higher if you're looking at 2 and 5 year at the moment compared to before the Iran war, which is why your mortgage rates have been higher. Now, if we're right in our view that actually base rate will be held flat and the Bank of England stick to the guns, then it does feel like there is a little bit of scope for swap rates to come lower, which would then in turn feed into lower mortgage rates. The one caveat there is that's not a Skipton view, that requires the market view to change, and that will be driven very much by the narrative coming out of the MPC and Andrew Bailey around whether they do feel that they're going to have to hike, or they give a message that actually we can go through this and we don't need to. At which point I would expect swaps to drop.
think it's fair to say, though, a word of caution is that as we've seen throughout the year, we don't know what's going to happen. And ultimately, from a broker's point of view, you're sitting with a client today, tomorrow, who wants to get keys to a home, and clearly we would hope that we'll see rates coming off and softening. But as we've seen this year so far, anything can happen, and ultimately it's about having a balanced view and doing everything you can to help that client today that you're talking to. I think you've got to be really careful when you're thinking about what might happen. We don't have a crystal ball. We don't know what's going to happen. Clearly, optimism is the right word. We would like to see some softening and some improvement in mortgage rates, but there's every chance that doesn't happen. As we saw, what happened at the end of February has had such a massive impact on the mortgage market this year, and there's ongoing uncertainty, which just means that we have to kind of proceed forward and helping people get onto the ladder based on what we actually do know today. Yeah. So that would be my word of caution.
Absolutely agree, and I think it's really interesting because when you speak to brokers, they'll be getting leads through, they'll do a dip with a lender, but then the pipeline maybe dries up, the customer doesn't commit, and they're almost waiting for the perfect time to buy, and you shouldn't really try and time the market, because you go back 5 years, you had COVID, then it was, inflation hitting 11%, you had Silicon Valley Bank that collapsed, you had Trussonomics, then latterly you've got, the Trump tariffs last year, and now it's the Iran war, then there'll be another story coming. So it's almost about, when you're dealing with your clients, that there is no perfect time to buy. If you're qualified, if you can buy, if you can meet the affordability, you've got the deposit,
then go for it.
Back yourself and go for it, because you're beating quite a lot of the population by even being in that position to buy.
Absolutely, and it's very much a human trait to err on the side of optimism and think that things are going to improve. I mean, I talk about this sometimes. I kicked myself a few years ago. I turned my nose up at a 10-year fixed rate at 199. I thought, don't think so, bit steep. I wish I'd taken it. Do you know what I mean? So we just don't know what's going to happen in the future, and so it's just getting that balance. But clearly, let's hope the optimistic view is right and it prevails, because that would be great to see some improvement.
Absolutely. So there's a lot of economic indicators, lagging indicators, forward-looking indicators. When you look at the economic calendar, it's pretty busy. There's a lot of data being released throughout the month, domestically and obviously internationally. So which economic indicators are you guys watching, and are other other mortgage treasury teams watching closely when forecasting what's going to happen in the future, and why?
Yeah, so I guess there's three. One of them is an easy one, which is inflation. As I said, that's the mandate that the Bank of England have. That's currently running at 2.6% for the most recent reading in June. We think that...
Ed, the Bank of England mandate, remind everybody, is to keep it at 2%.
Exactly, yeah. So the bank need to be at 2%. If they are consistently away from that, they have to write a letter to the Chancellor to explain why they're away from it. But the difference between the Bank of England and someone like the Federal Reserve in the US is the Bank of England, their mandate is inflation. It is only inflation, whereas the Fed in the US would be inflation and economic growth. Now, that doesn't mean that the Bank of England sit there and say, well, we don't care about economic growth, because they obviously do, because they come hand in hand with inflation. But that is the key thing that they are looking at. We think that inflation will probably peak between 3 and 4% early next year. You compare that to when we went through a similar oil price shock with Ukraine, where inflation peaked at 11.1%. And that probably leads me nicely into the second indicator that I'm really really watching at the moment, which is the labour market. So at the moment, we are seeing a labour market which is much looser than when we were in Ukraine. So what do I mean by looser there? Unemployment's at nearly a 10-year high. Vacancies are lower. People in work are lower. Wage growth, particularly in the private sector, is easing down to about 2.9%, which means that workers have much less bargaining power to go to the bosses and demand pay rises in the same way that we did through Ukraine. And the key thing with that, and the key difference, is that means that the second round effects of inflation, particularly in the service sector, are going to be lower, because people are not having that significant wage increase to enable them to, book holidays, go out to the pub, go to restaurants, all those sorts of things that then drive service inflation higher, which is the thing that the Bank of England worry about the most. Now, if those second round effects are lower, like we expect them to be, then it means that the Bank of England can look through that and hold rates for longer rather than having to hike them. And I think the final thing just to pay attention to would be the 6 Monetary Policy Committee. So these are there's 9 people on the Bank of England's MPC committee who vote for where base rate should be on a 6-weekly basis. 3 of them are currently voting for a hike, and we've got 6 voting to remain flat. When you look at the narrative from those 6, it doesn't feel like they're on a knife edge and they are very close to voting for a hike, which means that the majority should continue and therefore for base rate stay where it is. The other thing that I think is quite interesting here is around the MPC is because you've got 3 voting for a hike, and the message from Andrew Bailey, even though we don't think he's wanting to hike, is we will if we need to. Then that is feeding into the market, and the market is having to price in that risk, and that is why the market is pricing in effectively 2 hikes. So it's quite clever from the Bank of England that the narrative is almost doing the job for them. They haven't hiked, but because the market is expecting them to, that is feeding into swap rates, which feeds into, for people listening, obviously mortgage rates at the moment, but things like, you know, buying a car on finance, credit cards, any other sorts of borrowing from a business point of view, which then tightens the economy, and people are spending less, which means that inflation will come lower. So their narrative and their position at the minute is almost doing the job for them a little bit without them actually having to hike.
And explain hawks and doves then.
So a hawk is somebody who is wanting to tighten monetary.
So that's your 3.
That's your 3, yeah. So they are wanting to tighten monetary policy by increasing base rate and trying to curb inflation quickly. Your doves are the ones that are wanting to tend to cut base rate to try and boost the economy and try and you know, get more people into jobs, and it becomes easier for people to spend money, to borrow money, invest in businesses, that sort of thing. Nearly caught me there. I think I nearly got the wrong way around. But...
It's reassuring, you know.
Thanks for that, Ed. And thanks for your extra question there, Jen. So, should we be concerned about the recent escalations in the Iran conflict, and how could it have an impact on the UK economy?
Yes, we should. As I've mentioned, because of what we think on the labour market, we think the impact is lower. The caveat to that is the longer it goes on and the more it escalates, when you start to see oil prices up through $100 a barrel, which we saw 2 or 3 weeks ago, all of a sudden swap prices jumped. The market was pricing in 3 hikes at that point. Then that has to drive inflation higher. But where we are at the moment with oil sort of bobbing between 80 and 90 and sometimes just dropping below 80, it feels like the market can manage through that. It is a big unknown. There's a big unknown around Trump generally as well, that I think the market is almost getting Trump comment fatigue to a point where he's changing his mind so much of things. The market has almost stopped reacting. But at some point, it's like the boy who cried wolf, that he will actually pull through with something. The market won't be ready, and you could see a big change in swap rates. So I guess the message there is we could still have some volatility both up and down. So, you know, probably from more in Jen's world, you could be seeing sort of quick repricing or products being pulled if we're starting to see swap rates move quickly in either direction, depending on what Trump's saying. Yeah,
and I think we are seeing that, and I'm sure brokers watching will know that we've got kind of, it's an unusual time because it's so volatile and things are uncertain, and I think you've got different perspectives in terms of, are we going to see rates coming down or are they going to go up? And so that's being kind of reflected in mortgage pricing at the moment. So you've got a time where some lenders are pricing up while others are pricing down. Some lenders are making withdrawals, others are launching new deals. It's quite fragmented and hard to kind of keep an eye. It doesn't feel like it's all going in the same direction all the time, because clearly lenders have different strategies when it comes to pricing and hedging. And so depending on what day it is and what's been happening in terms of the price of oil and what Trump said that day, you might have swaps on an upward swing at the point that you're securing your hedging. So you're going to pass that on in your pricing. And likewise, if you've managed to time your pricing with a time when the market's feeling particularly optimistic, then you can cut rates. And that's difficult, I appreciate, for everybody in the market, because it feels like it's not a coherent direction to follow all the time. But yeah.
No, you're right, and a lot of it's out with our control.
Yes.
Some of it, you know, a good tip I would probably say is, if you are a mortgage broker, go to a free online economic calendar for the UK, and you will get the dates that the inflation print's due, the date that the labour market data is due to come out, GDP, etc. Some of the key indicators. Now, although that won't safeguard you against everything, because there'll be potential black swan events and escalations that nobody can control, but for you and your staff to work out when certain data is due to be released, and depending on whether that data comes in above or below what the market's forecasting, that can sometimes drive pricing and make the market volatile. So even if, as a basic, if you planned your week around the economic calendar or certain weeks where there's heavy data dumps coming through, it could help you and your staff actually decide what weeks you are going to work late and manage your work-life balance better as well.
Yeah, I guess my caveat would be the timing for how long that takes to. So if you get your data published on a Monday, and that might be kind of reflected in swaps immediately, that doesn't mean to say that the person that you've got a PT booked with, or the person that you're talking to tomorrow who you're thinking you're going to place with a lender, they may not change their rate. It kind of adds, but you're right, it's good to kind of have a view of directionally what are the things that might change the market, but there's going to be a lag between different lenders' response, and that always happens.
Yeah. Okay. So we've talked about some of the domestic indicators, we've talked about the Iran conflict, let's move to politics. So what will the likely impact of Andy Burnham and John Healey be on the mortgage market or financial markets?
Really good question, and it's an interesting one. I think the way that I look at this is, if you look at who's gone, so Starmer and Reeves have gone, and they were probably about as central as you would get in a Labour Party. So whoever was going to replace was always going to move slightly further left, and if you're slightly further left, historically you would want to be spending more, and if you're going to spend more, either taxes have got to go up or you've got to borrow more, which would typically be the way that a traditional Labour Party would operate. Now, if they are going to borrow more, because taxes probably don't get swallowed very well by your everyday people, shifting funding from, I don't know, NHS to something different, again, not overly popular, so it seems to lean towards borrowing, is that they need to be really careful with their messaging with the market. Now, if you look back to when we had Liz Truss and Kwasi Kwarteng, they didn't bring the market with them. I know they're a different party, but they effectively thought, we're going to go and do this, the market will just have to follow. And the market went dead against what they were wanting to do. Gilt yields shot up significantly. That increases borrowing costs for the incumbent government, which is in turn all inflationary, which is then forcing base rate to go higher just to be able to deal with that inflation. From what I can see and hear from both Burnham and Healey at the moment is, I feel like they're clever enough to know that they can't just try and blindside the market. The language they're using is right. They're trying to be fiscally constrained still. I expect them to spend more than Rachel Reeves and Starmer, but they'll deliver it in hopefully the right way, which means the market comes along with them and we don't see another shock or a spike like that.
Burnham did say, didn't it, before he actually took office, he made a comment that sticks in my mind, which is that he wouldn't be in hock to the bond market. And I think it'll be interesting to see how that, clearly now he's actually in number 10, he's taking a bit more of a measured approach. And I think that's interesting in terms of how we see that evolve over the coming months. And obviously when we get the autumn statement, whatever that looks like, the budget. Yeah,
and the budget's going to be a really interesting one because there's a lot still to be seen from I guess from both of them. But and to your point around whether people should be waiting, and I'm saying I think swap rates potentially could come lower. You list all those different things that have happened in the last 3 years. Well, the budget's going to be the next one. So if you're waiting for the Iran war to finish, and then something comes out of the budget that's left field that we're not expecting, then that can cause volatility in swap markets. So
so we've talked about mortgage pricing. We've talked about forecasts about base rate and swap rates, etc. House prices. What is the outlook for UK house prices over the kind of next 12 months?
So we are slightly more pessimistic this year. Two main reasons from that are what we've talked about an awful lot already. Iran war, inflation driven, which has caused swap rates to go higher, so affordability is more difficult. Through our Skipton group and Connell's, the estate agency that's part of the group, the largest estate agency in the country, we are seeing transactions are lower, and for those people that are still continuing to work through the chain, it's taking longer to get from offer to completion. There's more potential dropouts of the chain as well. So that has had a negative impact on the housing market this year. As such, we're now thinking that house prices probably grow by maybe 1% this year. when we then look forward into next year, it feels like there should be some pent-up demand there. Now, the caveat there is that we get some sort of end point to the Iran war, and we get through a budget without any left field policies that come from Burnham, which I don't think we would really expect. At which point, those people that have been on the sidelines potentially come back into the market, and you have maybe a bumper Q1, Q2. I'm not saying the same sort of level as end of stamp duty, but it definitely feels like there's some pent-up demand there. At which point, we think house prices probably 2 to 3% growth next year.
Okay. Are there any geographical areas that you think might outperform other areas?
So again, research that we have through our Connells Group, we see traditionally, if you look back to end of the financial crisis, London then went way ahead of the rest of the country. It's really been slowing the last few years. We're seeing areas, particularly in the Midlands, East Midlands and West Midlands, North West and Wales, are really pushing forward at the moment. And our forecast is that particularly in London, we're probably going to see flat, maybe even negative house price growth there. And I think we're seeing maybe around 20% of sellers at the moment in London are selling at a loss. So the expectation is that by the time we get to 2028, those 4 areas that I mentioned, Midlands, Wales and Northwest, will overtake London on an index basis from 2010 all the way up to 2028, which is quite interesting because everybody talks about London being this really expensive place, and it is in certain areas. But we're definitely seeing people moving away or at least relocating. And one of the other stats that we'd seen was for people that are moving in London, around 50% of them are now moving more than 50 miles from where they were. You'd look back to 2012, that was probably 30%. So it's really showing people relocating, I guess, going through COVID and seeing, wanting a garden, working from home a little bit more. Those sorts of things are driving that. So I think that's your big thing. You're seeing areas outside of London doing really well, becoming affordable, and wages have been increasing at decent levels there. London is stagnating at best. The only caveat to that is, from a London point of view, if the Middle East conflict drags on, do you start to see well-off professionals moving back from the likes of Dubai and Qatar and driving that market again there? But I think the message is mainly London struggling at the moment.
And that's translating into new build as well. When you speak to some of the national PLCs, the developers, they are struggling to shift units as well as they are in other parts of the country.
Yeah.
The sales teams within the City of London and South East are having to really work the pipeline and their customer nurture journey to get customers to actually buy. So it's definitely translating through. And I think Connells released some data as well, that one of their market updates was saying it was something like 50% of properties that were on the market nationally are receiving an offer within 5 or 6 months. But there's certain pockets, and it tends to be more up north, where it's 90% plus that's receiving an offer on the property within 6 months. So it's definitely playing out in some of the more granular data as well. Yeah.
I think the other thing as well, which is sort of linked to it, is just thinking about flats as well. We've been doing an awful lot of work looking at flat prices, particularly given the demographic change of your first-time buyer. So you went back 10, 15 years ago, your first-time buyer maybe in the mid-20s, no family, that sort of thing. Whereas you now, I think we're up at 34, 35 is the average first-time buyer, potentially married with kids. So all of a sudden a 1-bed, 2-bed flat doesn't really fit for their first house. They're wanting something with a garden, maybe 3 bedrooms. And therefore the demand for flats, particularly in some of the London areas, which are expensive, is lower, which is meaning the prices of those flats are coming down. So it's something that we've just been keeping an eye on internally as well.
Excellent. So back to Andy Burnham. So one of Andy Burnham's top areas of focus is increasing housing investment. How will that impact the housing market and mortgage rates?
Do you want me to go first on that?
Yeah, sure.
So I think housing market-wise, obviously we have a significant shortage of houses in the UK, particularly social affordable. So I think anything you can drive there, which is the area of his focus, is a positive. So it tries to and improve that supply, which potentially has a slightly weighing effect on house prices, which isn't always a bad thing, as long as we're not seeing significant reductions. But how it feeds through into mortgage market is a little bit more indirect. Him increasing the amount of houses there probably doesn't change where the Bank of England need to move base rate and therefore market expectations and swaps and mortgage rates. So I think in terms of actual mortgage rates, it's probably not significant. It's more on the supply side and getting more transactions through.
I think what will be interesting though is I think Burnham's been very vocal about the need for affordable housing and social housing, but think about affordable homes and some of the alternative routes that you have into home ownership. So things like shared ownership, things like Lift, Help to Buy, obviously no longer available, but things like that. I wonder if I would like to see more innovation from lenders, and if Burnham and his government, and obviously he's got Angela back in as Housing Secretary, what have they got? I would like to know what they've got on their pad in terms of how are they thinking about alternative models into home ownership with government intervention. And so I think from a mortgage market point of view, it'll be on lenders to think about how can we support that and how can we kind of innovate from a product point of view to help people get the keys to their first home through less traditional routes. So that'll be an interesting thing to kind of keep a watching brief on in terms of housing policy.
Absolutely. I think the developers would welcome it as well. So at the moment, I think it's about 30% of their sites to have to be affordable housing, whereas if Burnham's bringing forward, I think it's like 50 billion's been bandied about as the amount that it might cost to actually deliver the social housing plan that he's talking about. That would potentially relieve some of the developers of the burden they having to develop social housing as part of their planning permission or planning applications. So I think it could definitely have a knock-on effect and potentially free up the developers to get, crack on with what they're good at, their bread and butter, and actually just build properties and sell them in the private market. Right, I'm conscious of time. We're at 27 minutes past. I think this is it for 45 minutes. There's a lot to get through. We're obviously quite optimistic, or our view of the world is slightly more optimistic than what other economists are forecasting. What would you say is the biggest risk to our economic forecast?
Geopolitics. So we've got Iran war at the moment. So we talked about if that continues for longer than is expected, then there's a risk there. But even if that's dealt with, you talked about black swan event. That's the sort of thing that we're talking. I sit there and think about where globally could you have the biggest issue, and it's probably something like China wanting to take Taiwan. Taiwan, one of the biggest semiconductor producers. There's a Strait of Taiwan as well.
Semiconductor, please.
Semiconductor. They go into things for building your mobile phones, lots of AI technology,
Chips.
that sort of thing. Yeah,
But,
so
right,
it's all
okay.
tech stocks would take a big hit there.
Yeah.
So I think you look at the scenario of what we're seeing at the minute in the Middle East, it would be that, but probably times 10. Now, there'd be a big impact on China there as well if they decided to do it, but there's always been talk around.
Yeah.
They see it as Chinese land in effect. So, yeah, it doesn't necessarily have to be that, but that's probably the one that springs to mind.
Okay. And Jen, are there any customer segments that you believe are currently underserved or you could see increasing opportunities as the market conditions evolve?
Yeah, let's hope that Ed's right and that things are going to get rosier. That's only going to play through kind of favourably in terms of affordability, which is great for everybody. I think clearly Skipton are very focused on supporting first-time buyers, and what's been encouraging to see is that we've seen more lenders kind of taking a stand and being more proactive in terms of innovating and thinking about first-time buyers. But first-time buyers aren't a homogenous population. I think within that, there's a real diversity in terms of types of borrower and kind of lifestyle and employment conditions. And so I think that there's still more to do to help first-time buyers kind of who don't fit the traditional typical mold. We've talked about they're getting older. We know that we see more evidence of kind of non-standard income, self-employed. So I think that there's more for us to do as an industry to think about how do we cater better for the different types of first-time buyer that actually exist out there, not what we have in our mind that doesn't fit into a perfect box. And I think the other side of the coin is, in being single-mindedly focused on first-time buyers, we also have to think about how do we support people at the other end of the kind of home-owning journey, and that's those people that maybe are living in properties that they don't need to, that they're bigger than they need, but they don't have an incentive to downsize. It's kind of that side of the market. I think as a lender, we can think differently about potentially things like later life or helping to at least get that movement happening, because it's no good just focusing all your attention just on the first-time buyer segment, because actually to help people get keys to their first home, you need to be helping people who are already in homes that maybe want to downsize or move, but at the moment are ultimately disincentivized from doing that because of various implications, stamp duty being one of those things. So it's thinking about it holistically as a full end-to-end system, actually, I think there's first-time buyers and people towards later life. How can we think about those two different segments kind of towards the same ultimate aim, which is having everyone to have a home of their own, really?
Yeah. And it does sound like the industry's starting to come together on it. Even the regulator, you know, the PRA, the FCA, they published a paper last year, and it's now turned into, it was a consultation paper about 70 odd pages long, essentially asking lenders, what do we think needs to change in the market? Have things went a bit too far? What could we do as an industry to make things better? And now they've published the roadmap, and some of the things, you know, first-time buyers, a key focus area, complex incomes, self-employed, later life lending, interest only, etc. So kind of based on where that's going, you know, what would you say kind of stands out in the regulatory landscape that potentially will impact brokers watching in the market more broadly?
Yeah, I think you're right. There's definitely been a real change in tone from the FCA, and that's really positive to see. And I think there's an acknowledgement that an unintended consequence of some of the intense regulation that was brought in over the last decade and more, the intention of that was to ensure that we had a robust, stable mortgage market, which obviously everybody wants. But I think I know there's a realisation and acceptance that an unintended consequence has been that regulation has stifled innovation and has potentially left some would-be homeowners kind of out in the cold. And so it's been really encouraging to see that change in tone and shift in focus. And the FCA want to help the mortgage market to flourish. They want to see the mutual sector grow. So we're all for that. And I think that it'll be positive to see how that plays through over the coming months and years. I think particularly high on my agenda at the moment, loan-to-income regulation. So that's the FPC brought in a limit in 2014. Again, in the wake of the financial crash, it was around how do we ensure that as an industry are not over-leveraged in terms of people taking bigger loans than income that they can afford? How do we maintain kind of stability and responsibility? And I think that what we've seen is, again, an acknowledgement that that limit in its current form is potentially leaving people who can absolutely afford a mortgage. They want to get their keys, they're ready to go. They're not able to because of this kind of limit in the way it's designed now. And so it's been really positive to see that they are actively consulting on that and thinking about how can we reform this limit that was designed for a certain purpose. The market's moved on, buyers have moved on. How do we modify that to make sure that lenders can have more flexibility to execute their lending strategies in a way that works for the people at the end of that, kind of the real customers? So that's been really interesting.
Excellent. And I suppose kind of following on for that, you've got the regulator setting legislation, etc. But it's also important for lenders to remember that there is freedom within the framework. And I think that we're a very good example of that here at Skipton. So we, you know, launched Track Record. I think we enjoyed our third anniversary of it a couple of weeks ago. It's been very successful. It was the first product of its kind, you know, helping an underserved customer segment, customers that were in rented accommodation who could afford to pay the rent but potentially not save and not be in the position to take help from bank of mum and dad. So we launched it into the market. We were hoping that more would follow suit, and it's been a bit slow in the uptake, specifically with the rental products and the 100% LTV. But you have seen the likes of Santander come in with their 98% LTV product. You've got Lloyd's Banking Group that came out with their £5,000 deposit, and there's some other bits of innovation happening
as well.
Absolutely, there's other bits of innovation in there as well. So what do you make of this, and is it enough?
No, it's not enough. That's an easy one to answer. What I make of it more broadly is it's great. So we want to see innovation, and like you said, Jonna, like in May 2023 when we launched Track Record, we were kind of thinking, right, we've got in there first, but we're thinking other people might be fast followers. We were trying to rush in, trying to get this over the line. We want to be the first to go, and actually nobody followed for a while, and you know that's fine. We would continue to offer that product. We absolutely believe in it, but it has been encouraging to see other lenders kind of entering the fray in acknowledgement of something that we've been talking about, which is if somebody is living in rented accommodation, can pay their mortgage, can pay their rent every month on time, but can't save a deposit, why do we need a 10% or a 5% deposit to kind of validate affordability? What is that relationship? And actually, can we think differently? And so, yeah, I think it's great that we've seen the big banks particularly. It's encouraging because it kind of shows as a industry, like the big six lenders do 80% of mortgages out there in the UK. And so it's good to see them kind of in the mix now. And I think there's still more to do. We're still kind of tinkering around the edges in terms of the existing mortgage product design principles, and we could probably push them more. So that's what we're thinking about.
Excellent. Fantastic. So I've got some questions. We'll hand over to some of the questions that are coming in from the people watching online. And by the way, thank you for joining us, to take the time out your busy day to actually come and, you know, hear what we've got to say and potentially help you navigate the next 12 months through the mortgage market. So some of the questions that are coming in, so how important is flexibility becoming in mortgage product design?
Increasingly, I would say. Yeah, absolutely. And that's the point about, can we think differently about some of the things that we take for granted in terms of set LTV bandings, or we do 2-year fixed rates, we do 5-year fixed rates, and they have fixed end dates. There's some fundamentals of mortgage product design that I think there's an acknowledgement that that needs to evolve, and we can think differently about how do we design the structure of the product. But then even within that, thinking about conceptually, we take for granted that, you know, we have to have a mortgage payment from somebody every month on the same date, the same amount for 5 years. But actually, some people's income doesn't look like that. You might have people that are working kind of seasonally, or they're self-employed and they have loads of work at this point. And then, so why could we not have a mortgage that kind of accounts for that and gives you that true flexibility in terms of how you pay it down? So that's something we're thinking about. Things like interest only. I think interest only was really prevalent before the global financial crisis. Clearly, there's been lots of regulation and lots of rules put in place for the right reasons. But again, we now see hardly anybody taking interest only. And actually, it could be a really viable kind of stepping stone. And we could build that into product design. So think about if someone could maybe have a stepped product, for example, which I know was a thing of the past, maybe could that be put back on the table? So it's thinking about, I think flexibility is increasingly important. Flexibility in terms of product design, but also policy and criteria as well. That's kind of where lenders need to be thinking.
Yeah, and it does sound, you know, we all work here. We're not just sitting still. We've been innovative, but we will continue to innovate
absolutely
over the months and years to come as well. So this one's probably more for me, but you can definitely pitch in as well. So how can brokers help customers navigate affordability challenges effectively? So I would probably say there has been a lot of innovation, so use that innovation to your advantage. You know, yeah, we've had the stress rate changes, yeah, there's been the LTI changes, but there's also a lot of other products out there now making it easier for customers to actually buy and get on the market. You know, don't want to go into track record too much, but that's a product where it does look at the rent they're paying, and we can, I think when we started off with it was like for like, you know, just to play it safe. And then we gathered some data, and we then went to 120% of the rental value, and we can now potentially go up to 150% of the rental value. Obviously, we still do run affordability checks, but again, it's operating within that framework. I would probably say as well, customers only know what they know. Yep. So we are almost in a, not saying we're in an echo chamber or a bubble, but we kind of are, because we've got fantastic products, we've got great criteria, we're changing things, we're innovating. Other lenders are starting to do the same. But does the man or woman on the street actually understand that? Do they know that they potentially don't need a deposit to buy a property? When you speak to some brokers, some of the leads, so you know, for example, with new build, the brokers are getting leads for the developer, and a lot of the customers have already got a deposit, is what we're hearing from a lot of the broker firms. So it's about how do we get the message out there to the public to let them know that, you know, there are potential options here. So I'd almost say think about, if you're a broker, rather than just thinking about the leads that are coming into you and servicing those leads. And I get you're all busy. It's very hard to put your head above the trench and have a look to see what's happening out there. But I would almost be looking at a strategy to target your local community, or target businesses, estate agents, developers, and put a plan together to actually get the message out there to those customers. And I get there is a bit of red tape there. There's regulation. You know, there's financial promotions. So you need to make sure you're doing it properly. And a lot of the developers, they can't do financial promotions because they're not registered with the regulator. But there's got to be ways there that you can be innovative to get that message out there. And because 96% or 96% of our business comes from you, the broker. So a lot of our marketing is focused to you guys, but we need you guys to then take that message and get it out there in the local community. So I think I'd probably say just use the tools that are there at your disposal, but talk more about it and look for ways, get creative in how you can actually get the message out to your potential prospective customers.
Yeah, I was totally going to agree with you in terms of, too often I think people engage with the broker at a point where they believe they're ready to buy, and so they'll be, they maybe save the 10% deposit, borrow the 10%, whatever. And actually, there's whatever you can do to have that conversation earlier. And whenever I talk to would-be buyers, I'd say, go and talk to a broker now and talk about your situation, talk about where you're trying to get to, what your aspiration is. And then, you know, it could be sooner than you think that you're able to get your keys. So it's almost like, how can brokers facilitate that side of the conversation as well? Because I do think that there's a lot of jargon that we use in the mortgage market. We take it for granted because it's our day-to-day life. But for even people that have already got a property, they've already got a mortgage, they're not fully aware of all the options available to them and what might work best for them. So it's thinking about how can you add that value early on in the process as kind of soon as possible, which is going to get a good outcome for them, but also for you.
Yeah, excellent. And what should brokers, this is another question that's come in, what should brokers be paying closest attention to as we move through the second half of the year? So I think there's kind of two ways. Our forecast comes good, things get better. Purchase market starts getting a bit more vibrant. But if it doesn't do that, what should brokers potentially be doing? So maturities are a big thing at the moment.
Yep.
So when the purchase market is, you know, subdued, and it, you know, there's, I think Connells are saying they're expecting it to be subdued for the next sort of half of this year. What should brokers be doing when it comes to retention to help those customers navigate the complexities of the market, potentially for the first time ever?
It's linked to that earlier point, isn't it? It's thinking about engaging early and having the conversation and being proactive with your existing client base and thinking about who have we got that's got a maturity coming up and how can we offer our support now to start talking about options and have the conversation sooner rather than later. So yeah, I think it's working your existing book, isn't it?
Absolutely. We're nearly finished. We've got one more question, and it's came from Cameron Naylor. What was the website calendar mentioned the key dates for economic data? So before I say this, there are other calendars available. Okay, I'm not promoting just one website, but the one that I use and I've got saved is Trading Economics, and you can filter so that all of the other economies are out. You can just filter for the UK economy, and you can actually see the dates when the data releases are due to come out, and you can see what the market consensus is on what they expect the data to do as well. Okay, but again, bear in mind what Jen said. The market mortgage pricing doesn't always immediately follow whenever that data is released. But, you know, if there's big moves and big shifts in the data that we're not expecting, it can sometimes translate into quite a bit of volatility very quickly.
And I think the key thing that you mentioned there as well is for people that then go and look at that is look at the consensus. If it's coming in on consensus, then you would expect that swap movement should be minimal.
Yep.
It's when it's missing consensus. And one of the biggest things that I've said in these before when talking to brokers, particularly around base rate, is if you see, let's say we had a base rate cut tomorrow, immediately you'd have Sky News, BBC News, tabloids, relief for mortgage customers. Well, number one, not everybody's on a base rate tracker. In fact, not that many people on a base rate tracker. And number two, and the biggest one, if I leave you with any sort of message from this is, if the market was expecting that base rate cut, then it's fully priced in. It's already in your mortgage rates.
Yep.
It's only when something happens that the market isn't expecting, when you see that volatility or you see the movement in swap rates and therefore feeding through onto mortgage rates.
Excellent. Well, I think hopefully you've had a lot to take away there. There is a lot to unpack. Please watch it back. It has been recorded. Hopefully we've done a good enough job that a lot of it doesn't get edited out. Sorry if some of it does, if I've went a bit off piece. But yeah, use it, listen to it, educate your customers, have meaningful conversations, and potentially use it to grow your business. Yeah. And what I will say, I was driving down this morning and I heard on the radio, this is just a bit of cheese here to finish this off. Apparently we're expecting a solar eclipse here in the UK tonight. I think it's about 6 o'clock. So let's hope that the stars and planets align for the mortgage market in 2026 and beyond.
Love that, Jonathan.
Thank you very much, everyone. We'll finish it there.
Thank you.
Thank you for tuning in. Goodbye.